Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Tavi Costa, the CEO and founder of Azuria Capital. How you doing today, Tavi?
I'm doing very well. How are you?
I'm doing good. My portfolio's been looking good, but, sometimes I'm just trying to make sure I'm not getting too bullish, and I'm being objective in how I look at the markets. And I really think that your information that you put out, your tweets and all of that, all the charts you put out and such, it really helps me look at it more objectively. So I always appreciate your take.
Thank you very much. Looking forward to this.
Yes. So I want to get your 2026 outlook on various commodities. First, I want to start with gold, and typically I would say gold and silver, but I think that silver has a lot of different driving factors for its significant outperformance, which are some of them are different than gold. Many of them are different than gold, like the industrial demand and such. So I want to separate those two out. But let's get your outlook on gold for this year.
Yeah, I never think of the world or in terms of assets from a perspective of a price target for a year. I'm always thinking, long term, 3 to 5 or even 5 to 10 years ahead. I think that the biggest challenge we're having right now, it's funny. You either have the challenge of investing on something that doesn't work and you're too early, or you invest on something and it goes really well and everybody starts talking about how this is the peak of it. So for a long-term investor, you really need to step back and think about the fundamentals of this industry and what really causes the peak of the cycle. There's a few checklists that I would put out there that I think are very important, which I think are related to gold. Logically, the mining sector is tightly related to gold prices. And so understanding the gold price and where we are in terms of that, it's absolutely critical to understanding where we are in the mining cycle as well. I think gold is still, believe it or not, it's at pretty much at all-time highs nominally, but relative to money supply, relative to where credit is globally, we're nowhere close to where we could be in the future. And so that to me gives me enough conviction that this rotation out of very expensive, overvalued financial assets into hard assets is at its early stages still. And I can measure that in many ways. You can look at, for instance, the gold to S&P 500 ratio. We're still close to levels that we were back in the peak of the 1929, back in those days before the Great Depression. By no means I'm calling for a Great Depression or anything along those lines. I just think that there is a very significant rotation happening into hard assets that people are not so much emphasizing. And as we continue to see this, family offices, pension funds, endowment funds, they still have to start really allocating capital into hard assets overall. And commodities is going to be a big portion of that. Gold is attracting most of that initial capital. But what really drives gold right now is central banks. And central banks are doing most of the buying, and it's been great. But if you look at from those lenses as well, central banks still own sub 30% of their balance sheets in gold. And historically, we have seen in the past well over 70 to 100% of their balance sheets being held by gold. So I would not be thinking that this is, a near-term, peak of the cycle or anything along those lines. We can see corrections and all those things will come and go. But think of this as the kind of the S&P 500 trend, after the tech bust or after the global financial crisis. We're kind of in that stage where things are just getting momentum, awareness, but we're nowhere close to the end of this, in my view.
Yeah, appreciate that. So looking at the gold to S&P 500 ratio, I think right now it's about an ounce and a half or a little more than that to buy a share of the S&P. And so historically, we've seen, I know in the last bull cycle, we've seen that go down to like a little less than 3/4 an ounce of gold to buy a share of the S&P and such. Right now, the S&P is still at all-time highs measured in dollars around those ranges and such. And so many people are parking their money there thinking that they're beating they're beating inflation, they're beating the market, and things of that nature. And so just curious on your perspective of when we begin to see that capital rotation. I think we've seen some of it, but not fully. We do see like more bigger banks are talking about gold and such, but I haven't heard my cab driver, mention gold yet. And so just curious in your perspective on that.
I think that's a good anecdote. Every time I go to a restaurant or a social setting with friends and family, what I realize is that the questions never evolve around acquiring mineral claims and creating a mining company or investing in the mining space or buying commodities or investing in gold. It always evolves around, especially crypto, technology, AI. And so the world still is very focused on those trends, which there's nothing wrong with that. But to me, it's fascinating. For instance, Roundtable of Barons was just published. Every year they put out this research that they speak with a bunch of fund managers about their ideas for the next few years, and gold was barely mentioned in those ideas, and I thought that was remarkable. So we're still early in a lot of these trends. Most of the sort of traditional fund managers are kind of thinking in the sense of, have we seen too much of a move for us to be allocating capital? And that's, to me, that's not the sign of a peak, right? The sign of a peak is a total FOMO, fear of missing out environment where people just start buying it nonstop. And I don't think we're there yet at all. This rotation out of the S&P, look, I think there's a lot of focus from some investors on when will the S&P 500 and equity markets overall start correcting in order to allow that capital outflows to come into gold and other things. I'm not too focused on that, because where we are today, we have to think about one thing, and that's a very possible scenario. But the reason why I'm not too focused on this is because there's a few options that policymakers have, and very few, actually, I should say two options that policymakers have when you reach this level of indebtedness. And although debt is not as relevant as the burden to service that debt. The burden to service a debt is way more relevant than the debt itself. Once you reach the levels that the US have reached, which is about 4 to 6% of your GDP, that range is so critical. Throughout history, when you hit that range, monetary policy becomes, well, I should say, policymakers that are looking at monetary policy become irrelevant. Their view on inflation, their view on unemployment, who cares? It's not about that. It's about reducing rates to allow the government to pay its debt. And I don't care where inflation is. Inflation could be rising. Inflation could be declining. Unemployment could be rising. Unemployment could be declining. Who cares? Interest rates need to decline for one reason. The government needs to afford the debt and also reduce that burden in order to continue to invest more in the economy. Think about a pie. Think about the investment. The fiscal spending is a pie. Majority of the pie right now is coming to interest payments. That's a burden that they are putting on themselves. If they lower rates, that money could be reallocated into growth. It could be made, it could be making bridges and data centers and all sorts of things. Yep. Now, I'm not saying here that wouldn't have an impact on inflation and other aspects. Of course it would. That's the likely path, though. And if that's the likely path, I'm not sure I want to be necessarily ultra bearish on things. I just want to be very long hard assets, because ultimately those are the things that are extremely cheap in an environment that might see financial repression from governments in order to allow them to breathe and be able to, to really live in this environment of too much debt. And so that to me is critical here. This is why commodities are just such an important and a core piece of what I view as a perfect portfolio.
Yeah. Appreciate that. So thinking about this level of indebtedness and lower interest rate environment. So we know that recently Jerome Powell was brought under investigation and such. And he mentioned that it was because the Trump administration wants lower rates. I'm curious along with that M2 money supply, in terms of the inflating away debt, or increasing the money supply to where the dollar loses its value. I mean, so President Trump did say that he was going to add 500 billion to the military budget and such. And in my view, it's like, okay, well, that's going to be more money creation. And and then it's also going to devalue the dollar even more. And so just curious in your perspective on the dollar moving forward under those types of environments.
Darrell, you've done your homework, and I appreciate that, because I definitely have a very strong view on the dollar, and I think it's a critical piece here as well to this whole equation. In my view, eventually, we can all look at the interest payment to GDP and say, well, that's a big problem and we have to address this. But it becomes a bigger problem in particular for two reasons. One, if you looked at relative to the globe or other countries, interest payment to GDP in the US is drastically higher than any other place in the world. Pick Japan. Japan has higher debt to GDP than the US. But because rates are so low in Japan, and forget about the 30-year, what's happening in the long end of the curve in Japan is sort of meaningless because most of their debt is actually in the short side of the duration. And so when you think about this, the US has a much greater sense of urgency to lower rates than the rest of the world. And that will have an impact on the dollar by itself. Now think about something else. We're all focused on the fiscal deficit and how much we're spending. You know, you rightly pointed out what's happening with the military budget and so forth. And now I talked about the pie here. All that is going to continue to move. Now, another problem that has structurally become a problem over the years is the current account balance. So we've been importing more than exporting over the years to a degree that we have only seen back in the 1800s. Okay. So that alone needs to be fixed. How do you fix that? Well, if you study economics, one of the ways you fix that is depreciating your currency and versus other fiat currencies. I'm not talking about versus gold and silver. That is sort of, I wouldn't call it the obvious, but the more very, very likely scenario to continue to occur. But think of this as the dollar being extremely overvalued in an era that we need to fix the current account deficit issue. At the same time, we need to fix or address this interest payment relative to other countries. And I can't believe those two things will occur without having a meaningful devaluation of the DXY index. To be very specific on an instrument, DXY index needs to be extremely devalued in my view. And as that occurs, I think it will unleash a lot of other opportunities. That's where you see emerging markets start performing better. That's you see a rotation out of the US into the rest of the world. Other developed economies that have potentially really underperformed the S&P 500 could start actually performing better. And the way you see these things in macro, these things never work all at once. It's not like you wake up and then everybody's just investing in, Japan, Europe, emerging markets. No, those things don't happen that way. They happen over time. And so you start seeing pockets of markets beginning to attract capital first. You saw Argentina, and now you're seeing the whole Latin America region. You're seeing actually China performing better than the US in the last year or so. And Europe is performing very well. Japan has been performing better than the US. So all these things are pockets of the markets that are starting to do better. And I think generally we're going to see that over the next 5 to 10 years. These cycles of outperformance of the rest of the world versus the US are also long-term cycles. Those are things that happen through 5 to 10 years. And I think we're just seeing the beginning of that. So one way to really officialize that trend, in my opinion, is paying attention to the DXY index. If you take a chart of the DXY index, and not to get too technical here, but from 2011 to today, we've been, sort of in this upper trend. And every time we hit this support line, we bounce over and go up again. And we hit the support line and then we bounce over and go up again. I really believe we're at that support line again. The whole world thinks we're going to bounce it. I don't think we're going to bounce it. I think we're going to break. And that's going to be the signal that everyone will see that as the beginning of a downward trend. When everybody sees that break, and I love Paul Tudor Jones' famous sentence on this, it's not focusing after the breakout. It's focusing on the breakout. The reasons why something could meaningfully break historically and start a real long-term trend that people are not paying attention to. And they all have to reallocate capital accordingly because you were right about that shift. And I think there's a real justification and a long list of compelling cases here that we can take, that I think the dollar is about to enter a downward trend relative to other fiat currencies.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
The S&P has been, it's made up of 500 companies, but it's been about 7 that's been keeping it up, keeping it elevated. And I was thinking about growth, like how much more can these companies grow? I mean, I think Google hit 4 trillion, Nvidia hit 4 trillion, Apple is in the trillions and such. And, and then also when we think about the AI capex, how much money was going into the AI, 500 billion here and, 200 billion there, and such. And so I was kind of thinking about that, like, okay, how much more can these companies grow? Because there's so many other undervalued assets, like, as you mentioned, emerging markets. So me personally, I'm into some of the South American stocks, Brazil and such. And then, I've also been looking at India and such. And so just curious in your perspective on that rotation out of it, because I do think that a lot of these stocks are losing steam. We're seeing news coming out of Oracle and some issues they're having and such. Yeah. And so just curious in your perspective there.
No, that's a good question. I think it's logical to have the type of, or rational to have the allocation you have in South America. I think there's something structural happening in that region, by the way. We can talk about that later. Regarding the AI related stocks or technology companies, what matters here to me is, first of all, there's a few things that we need to put together. Number one, we know that these guys are in a true arms race. They believe that spending is absolutely critical to survive. They believe that scaling up is absolutely critical to survive as well and to compete in the future. And you can think of that as they are unlikely to stop spending anytime soon. And the main reason for that is because a lot of people think that their capital is coming from debt and coming from other instruments. And while there are some cases that we're seeing that, in aggregate, if you looked at the entire FANG or, I don't know, Mag 7 or largest tech companies and aggregate their assets versus debt, they're not levered at all. And these guys are probably generating in about $500 billion a year in free cash flow. So what is likely to come is that 500 billion is going to shrink likely because the spending is going to increase. So what I'm saying is most likely we're going to see a shrink of their free cash flow over the next few years. At the same time, some companies will choose not to shrink their free cash flow and instead increase leverage. But there's room for increase of leverage. They still have, last time I checked, they had a net cash balance, meaning they have more cash than debt. And we're probably going to be in a world where these guys are carrying about 30-40% of debt in the future. Call it 5 to 10 years from now, which shocked me for not in a place where they have substantially deteriorated their balance sheets in order to address the spending. And when you think of the world like that, the question for investors in that camp that you're probably going into is, how would very high multiples, price to sales, price to free cash flow, price to book, look like if they're going to deteriorate their balance sheet and potentially reduce their free cash flow in the future? And of course, the assumption I'm making here is that they're not going to be making more money with AI in the future. Let's just say I'm wrong about that and they make more money, and they will continue to spend more, right? So what I don't want to, so as you can see here, there's one common, potential outcome that I think we should really focus on, which is the spending. Mm-hmm. They will likely continue to spend. I would not be short that idea. Like that's probably will continue to, capex will continue to come. I think that there's a lot of doom and gloom on that, that I disagree. Just look at the data. I'm sure some companies like Oracle, maybe they've done it too much. But you look at Amazon, you look at Meta, you look at Google, these guys still have a lot of balance sheet to deteriorate here. And sure, if their stock starts to perform worse, that can change things here and there. But for the next 5 to 10 years, if they view this as absolutely critical to survive, you would suspect that they have to spend, right? Mm-hmm. If you have to spend, you have to. And so, if you have the runway to do it, so here's my focus that I'm very curious about how this will, translate into opportunities. I think about this bucket of capital that will continue to be spent by these companies, and where will they go? And I view this as sort of other buckets of, areas that money will flow into. And it's either energy, because we need the energy infrastructure for the data centers and AI, the onshoring, the industrial capabilities, blah, blah, blah. All that needs to be done. It's the materials, right? We're talking about material sectors like the mining industry that is grossly undervalued relative to all that capital coming into. It's the government spending and allowing the mining industry to grow. There's so much that needs to be done there. There's cement companies, like all these companies that work on building things. That's going to be a huge part. And then the third pillar, think of the infrastructure, right? When there's going to be a bunch of infrastructure that needs to be done, the utility companies, all these things need to be worked on. There's going to be opportunities there. Now, that's a little heavier market cap in aggregate than these other two buckets, but still going to benefit. And then there's another bucket just to consider, financials. Now, who is going to be doing those deals, right? Like if these companies are going to be raising debt and raising money for well, where's that going to come from? Financials going to have to link that bridge, right, of these pillars versus the AI companies. And so I think these are going to be pockets of ideas to invest in the future that could be quite attractive for investors. My focus is in energy and materials at the moment, but I see other people skinning the cat on utilities or maybe financials and so forth.
Yeah. Thanks for that perspective. So I do want to touch on oil and gas, but before we get there, I want to get your take on silver. So obviously, silver has many industrial uses as well as it's on the critical minerals list, and then there's this monetary demand and such. What's your outlook on silver?
No, silver has been one of my babies when it comes to ideas in the last few years, and I think monetary metals, they reach such undervalued periods that they become more industrial. And this is where we saw silver in particular over the last few years. Do I suspect that we'll continue to grow the demand on industrials? I'm not as bullish on that. I think you need to think about silver now, and that's the transition of the metal currently is mostly into a monetary demand. Either central banks could start buying silver. And I can certainly see that. In the past, that used to be the case. Central banks used to own silver in their balance sheets. You know how much they own now? Close to none. And so, that could be a major, major shift of demand that nobody's seen. And I do think that that's a very, very strong potential tailwind for the metal. Now, what actually attracts me the most outside of the demand, of course, there's demand for solar panels, which kind of in my view, just put a floor on the silver price, right? If silver prices go back to $20 an ounce, which I don't think will be the case, I think, if you're a solar panel company, you would be jumping on that opportunity because that's an opportunity. And look, I think that the genie is out of the bottle right now on silver, and a world that we lived in where metal prices used to be very cheap, I think is behind us. Of course, after 10 years, 15 years, we're going to go back to a cheap world of metals at some point. I don't know when, but we will. But in the next 5 to 10 years, I just don't see that. And I think there's an opportunity there first. I think that a lot of people are thinking that silver will mean revert and go back to other I think it's totally plausible to see a support at $50 an ounce or maybe $70 an ounce. And, that is not the world that the mining sector is pricing in today. The world of mining is pricing that silver prices will go back to $20 an ounce. And I just don't think that would be the case. And so there's lots of opportunities on that repricing of the idea of seeing long-term metal prices higher than or elevated in historical standards. And I should also point out on silver specifically is what are things that should really change the price here? One of the things we tend to see is that after a big run up in prices, you tend to see production follow. And it's not like the silver prices have been, ran up, just recently. Like if you look at the price of silver over the last few years, call it over the last decade, lots of ups and downs, but it's been in the upper trajectory. And that alone should have driven the supply side much higher in terms of production and other things. And we're not seeing production rise. Production, in fact, is contracting. And that is something that is really concerning because we also know that we have not seen enough discoveries of silver as well. So I think that that's a real problem and that people are not paying attention to. Capital spending, for instance, look at how much silver mining companies are spending in terms of, deployment of new mines and new projects to come online. They're not spending enough money relative to the metal. If you looked at, just use gold as your inflation gauge. Look at capital spending relative to gold. We're at all-time lows today. And that is not a peak of the cycle, metric. And so pay attention to that in my view. If you're, viewers that are looking at this as an investment for the long term, I think that's one of the most important things. Look at the M&A cycle. Where's the M&A happening? Mostly across the seniors. Yep. As seniors buying seniors, merging, or seniors buying maybe large mid-tiers. But we're not seeing that speculative environment where seniors start buying the small companies. Now notice that investors are starting to say, wait a second, where is the growth going to come from these companies, from the mining industry? And they're starting to pressure management team to do what? To increase growth. But there's no discoveries. So how do we increase growth? Well, there's a simple answer to that. You acquire a project that will become an increase of your resource as a company. And so I think that's the next step that we're missing that would be highly lucrative for those that are in this industry, in my view.
Yeah. I'm glad you mentioned the production because I know that the mining deficits have been consistent year over year. Ore grades are declining, and then obviously it being a byproduct of other mining. So we're looking at the opportunity here. I'm in communication with the stackers, the folks that just buy the physical, in which I own physical silver, but then also on the mining stocks. And I think the mining stocks are like, can be silver on nitro. And so just curious in where you see the most opportunity. Do you see more opportunity in the junior mining sector versus like the physical metal itself and such? Because, if these bigger companies have to get these projects to grow, I could see some of these junior silver stocks like skyrocketing and such. And so just curious in your perspective there.
I think the most important way to think about that is, consider the fact that most of these silver companies have, metal prices have a big run up. Do you prefer buying silver, at $80, $90 an ounce, or do you prefer buying a mining company today that can produce at sub $20 an ounce cost, right? Yeah. Like every dollar that goes up right now is an increase of margin that people are not really considering. And to me, that is just nirvana. It is the best thing in the world to be, in my view. And of course, I could be wrong. And I think the market is overly pessimistic about future prices of silver, and therefore why most people are behaving the way they are and not deploying capital in the silver mining industry. If you look at the silver mining industry relative to silver prices, you will see that the ratio has been collapsing recently. They are not keeping up with the silver price themselves. And I just don't think that would be a continuation of a trend. I think that reminds me a lot of how miners were lagging gold prices themselves. Like I remember seeing, I was buying call options on VRIC and Hecla and all these senior companies. Hekla would be a not the greatest example because it's a silver company, but think of mostly of VRIC, for instance, would be a great example where people were just losing faith that silver prices or gold prices were rising and the senior miners were not following. But what happened after that? We saw a major follow-up on VRIC and other companies really taking off after that. And the implied volatility of those options was just not pricing in that type of upside volatility that we saw. And that's sort of the idea here with the junior miners. But junior miners, I wouldn't necessarily consider this from a derivative standpoint because they are almost derivatives themselves in terms of how much they move. And so you can kind of like pick the, sort of the high quality assets in the space, which is that alone is not an easy job. There's the reason why people have not deployed capital there as well is the complexity of this industry, which to me is an opportunity. The complexity is where we as money managers in the space need to find a way to bridge capital from people that don't understand the industry, that people that do follow this industry for a long time and have technical expertise to deploy that capital. So I view that as an opportunity and a lag. I think that lagging environment is likely a very favorable environment for investors rather than a problem itself.
Okay. Yeah. Appreciate that. Okay. So copper, I want to touch on copper. Copper obviously had a move up. I was looking at one of your recent charts where you posted copper and gold has broken out and oil and gas is kind of building this momentum and such. And so before we get to oil and gas, I do want to touch on copper. What's your outlook there in regards to opportunity?
Wow, none of us have enough copper here because copper is in a very, very special place in terms of technical position. We have we have plenty supply of copper in the world. The problem is we don't have supply above ground. That's the issue, number one. And the only way to bring that supply into above ground, let's say, is that the price makes it more economical for those projects to come online. And the problem is it takes forever for these projects to come online. And there are almost no projects coming online over the next few years. And you look at discoveries are basically single digits relative to what used to be high double digits in the past. Okay. In terms of pounds of copper that have been discovered. And so, I think that the world we're in right now is a very scary world in terms of that. I think we're going to see a repricing of copper to a degree that a lot of people are not, maybe it's similar to what we saw with silver and maybe similar to what we saw with gold. And why does that happen? That happens usually when you have something called a price discovery phase. It's when a metal reaches a price level that just we have never seen in history and there's no resistance whatsoever and there's a bunch of demand and there's not enough supply. And that world, good luck trying to figure out what the price is. That will find some resistance. And so I'm not in the game of figuring out what the target is. I'm in the game of figuring out the value of owning something today that potentially could be much larger in the future. And then I will adjust my view as we see the response in the mining industry of, just like silver. Silver was in that case a few months ago. And look at the run up we had. And the same thing is likely to happen with copper. And we're going to have to sort of monitor that as we get there. So opportunity today, but as we get there, we're going to have to see, will the supply curve change? My suspicion is that it will not. And I know that how long it takes to technically get something into production. And it takes 10 to 15 years to get a mine into production. And we know there's nothing online here about to get into new supply for the market. So yeah, buckle up. That's what I would say. Again, my views, I'm sure I could be wrong and do your own research, but this is where I have to get conviction and come up with views to deploy capital myself. And I view copper in this special moment that you can see an explosive move and substantially higher prices on that.
Yeah, that's good. Well, Tavi, I have to say, a lot of your views have been correct. So, I mean, based on history, based on research, and so you do your due diligence.
Thank you. Appreciate this.
So, lastly, I want to touch on oil and gas. So, oil and gas, many of the bigger institutions are bearish on oil and gas. It's been trading lower. Many of the names in our sector are buying oil and gas and such. I've been owning oil and gas as it's one of those assets that isn't loved, and I know eventually that it will mean revert. And so, just curious in your perspective there and opportunities you see there.
Yes, I think it's important to put this also into perspective because it's not like I'm calling the bottom for oil here or calling the bottom for energy stocks here. That is not a job I know how to do well. I'm just being very clear. I'm not a trader. What I think I know how to do well, and this is I think this is an exercise every investor should do, is to really think about what's their edge here. And what I view as my edge, this is my opinion on my ability, is to identify these long-term trends and act as smart money when things are dislocated in the market. I view energy in that place. This is the smart money phase of energy, in my 2 cents. Gold, emerging markets are in the awareness phase, okay? People have seen some returns, and now they're sort of thinking, is this the end of it? And usually that's never the end of it when people are thinking that way. It's the beginning. Mm-hmm. Okay. Energy is in a different phase. Energy has been consolidating. There's two things in energy. You can break down to oil and gas, but let's just talk about energy overall. There's energy commodities, and then there's energy stocks. Energy stocks have been extremely resilient relative to energy prices. However, if you looked at the price of energy stocks, and I have a chart that I usually show where you had gold miners surging, copper miners surging recently, and then you see the price of energy stocks, they follow each other historically, and recently has been a major lag in this energy equities. A lot of people think about these components of the commodity space separately. People like to talk about gold as the safe haven, copper as more cyclical, Dr. Copper follows the economy, energy its own animal. I don't believe in that. I think they're all interconnected. And I believe that when you're in the bull market for commodities and hard assets, which I believe we are, you keep rotating into assets. There's always the flavor of the year, the flavor of the month, the flavor of the quarter, and you have to focus on those like a laser. When you have a commodity like energy that has been consolidating for over 2 to 3 years, it has to be under your radar. It has to be under, as a smart capital investor, in my view. And so I do think that this is the place where you start accumulating. And I don't know when it turns. It could turn tomorrow. Iran, something happens. It could be a geopolitical problem that triggers. It could be just fundamentally what we're seeing with the industry in terms of, rig counts that have been contracting over the last 3 years. People mentioned that that's efficiency. It's not efficiency. Nothing declines by 30% in 2 years because we're seeing efficiency. Hasn't been that level of efficiency in the industry. It's because prices are too low and companies are putting their foot in the brakes here in terms of production. So eventually that leads to lower production. Other things we're seeing, positioning. You mentioned positioning. The sentiment is so negative. That is also a good sign. So, and then you look technically on oil prices themselves, because I think that's the big animal here. Look at oil prices monthly. Take a candle chart and go back as many years as you want. And you're going to see that prices go back to the global financial crisis. They peaked during that time. And you draw a line all the way down, and you will see that we historically, before COVID, we were hitting that as a resistance. We would hit that line and go down, hit that line and go down. COVID happened. Oil prices went negative. The policy response was absolutely nuts. We saw a change in administration when Biden took over. And then that was the change of the energy space, right? And then energy broke out and we saw inflation going crazy. And And now we saw that peak during the Russian-Ukraine war issue. And then from there, we've been actually retesting the same line. So that line that used to be a resistance is now right on support. Now, it would be really interesting. Market loves doing these things where everybody thinks that, oh, Venezuela, these, it's going to bring new supply. Market loves looking at the obvious and saying, I'm going to do something completely different here, and I'm going to make the bottom of oil prices right when everybody thinks this is actually, the news where things should be following even further. So I would pay attention to, I'm not saying, supply of oil, there's all sorts of reasons why you should think that the supply of oil through Venezuela would take years and maybe decades to come online. There is a case there as well, very obvious, because of the impairment of the assets and so forth, and the time it takes to get those things back into production. Maybe there's regulatory framework that needs to change. Oh boy, there's so many things there that you can tap into. But regardless of that, think of just the price action we're seeing. Despite this, that should have been seen as potentially a more positive thing for oil supply, right? And I think that's key. When you start seeing that type of performance in oil, I'm paying close attention to it. In fact, I've been deploying capital into the space over the last months.
Yeah, definitely. Appreciate that. You got any thoughts on the cost of production versus where the price per barrel is? And so what I've heard from multiple analysts is that the cost of production is already tight between where the oil price is now. And so just curious if you have any thoughts there.
Yeah, no, it's very tight. And, this is the type of place in terms of oil prices and the cost structure where you should be thinking about how oil companies are going to be extremely unincentivized to increase production here. And if you looked at globally, yes, the U.S. has increased production, not in a major way recently, but who has been carrying the torch on that front has been certainly the Saudis. And you have to consider the idea that the Saudis' revenue from a government standpoint is highly dependent on that. And they need capital right now. I mean, they're going into one of their biggest changes, structurally speaking, as a country, to focus on mining and other things that we've seen throughout history. And if there was ever a time that the Saudis are, in high demand for dollars in terms of revenues, I think it's now. So I find it that is highly unlikely that we will see this level of increasing production in the near future. Most likely the U.S. could also see some issues here in terms of the Permian starting to peak its production as well. So yeah, I think there's, usually follow drill rigs and the count of those, because they are a very good leading indicator for production. So no, maybe this time is different, but there's a lot of those, situations in the oil space. Like, if you look at positioning, is this time different where positioning hits at all-time lows and oil doesn't turn? Maybe. Are we seeing this time is different as well in terms of gold to oil ratio? Like, think of myself, I guess, or yourself. How much metals and mining exposure you have in your portfolio, right? And I have it's the core of my portfolio. What's my risk? My risk is that, especially in the mining side, is that the margins of these companies, I was just mentioning that silver price is at 80 and these companies are producing at $15, $20 an ounce. Okay. What's the risk here? The risk is that that price goes up and the margin gets a squeeze. What could cause, as an investor, think about it. What could cause a shrinkage of margin economically? And that is energy cost, in my view. One of the biggest things is energy cost. So you, as a mining entrepreneur, you need to be thinking about hedging your energy costs at these prices. I mean, why not, right? Or as an investor, you should be thinking, well, I should have an allocation here to energy. That's the hedge in my mining portfolio. That doesn't mean I'm bearish mining. No, it's just a smart way to have a little bit of allocation on something that looks extremely asymmetric, more asymmetric than Latin America and mining today. Doesn't mean those things shouldn't keep going because there's structurally changes happening in those two themes. But energy today is extremely asymmetric. So putting a little bit of having a portfolio allocation there is, I think, very plausible, intelligent, and that's how a smart money should be thinking about things, in my view.
Yeah. Thank you for sharing that. Well, Tavi, where can people connect with you, find some of your research, your work, and such? Plugged audience.
Yes, they can find, they can always message me on Twitter, at Tavi Costa, LinkedIn. I post a lot of things on LinkedIn as well. Those are the two places right now that people can reach out to me. I have my email address there, on the Twitter page. Still working on launching a firm, but things should be up and running soon. And I'm really excited about what's ahead. And this market definitely keeps me up. And I can't wait to deploy more money into a space that I believe so much, which is all these ideas that I shared here with you. But so thank you very much for the opportunity to share my views.
Yeah. Thank you for coming on the show, and thank you for being accessible to the people. I mean, you got your email address, you got your LinkedIn and everything, so you all can reach Tavi if you have any questions or any thoughts. And so thank you for coming on the show. Look forward to having you back sometime as things continue to unfold. Thank you.
Thank you.